Love that video. Good morning and welcome to Poly's Investor Day. My name is Mike Iberg, Head of Investor Relations. We're glad so many of you could join us today. We've put together a great couple of hours of content, which we hope will give you a better understanding of Poly, our markets, products, and opportunities. If you're wondering about this big wave over my shoulder, we're here in Santa Cruz, California, sharing the stage with our virtual sales kickoff meeting taking place this week. The theme for this year's sales meeting, it's all about catching that big wave of demand. Turning to the agenda quickly, Dave Shull, our CEO, will open, walking you through our overall strategy, markets, and areas of focus. Chuck, the CFO, will follow with a quick recap of FY21 and the progress that we've made improving our profitability, reducing debt, strengthening our balance sheet. He'll wrap up with his perspective on FY22 and beyond. We're also excited to have Grant Hoffman, our new supply chain officer, to discuss the state of our supply chain and where he sees opportunities ahead. We'll then move to the three product GMs, John Lamarck, Bo Wilder, and Christine Roberts, to discuss our product portfolio, direction, and why we win. Laura Marks, our Head of Global Alliances and Product Marketing, will take a few minutes to discuss our strategic alliances and our go-to-market strategy. Then Dave and Chuck will host a 30-minute Q&A session, and Dave will come back at the end with a few closing comments to wrap up the event. Now, I'll take just a moment to go through the safe harbor. The information presented and discussed today includes forward-looking statements which are made under the safe harbor provisions of the Private Securities Litigation Reform Act of 1995. The risks and uncertainties related to such statements are detailed in our most recent 10-Q, 10-K, and today's presentation. You should also refer to the materials we provided today for an explanation of the non-GAAP financial measures discussed during this event, along with a reconciliation of those measures to the nearest applicable GAAP measures. These non-GAAP measures are indicators that management uses to provide additional meaningful comparisons between current results and previously reported results, and as a basis for planning and forecasting future periods. The materials presented today will be posted on our website shortly after the event at investor.poly.com. With that, I'll now turn the event over to Dave. Dave?
Thanks, Mike. Good morning from California, everyone, and thanks for joining us from wherever you choose to work. It turns out we couldn't have picked a more appropriate time to host an Investor Day as a company. This week, we are celebrating the 60th anniversary of Poly, when two pilots got together back in 1961 to create a more comfortable, lightweight, high-fidelity headset. Against that backdrop, it's a little bit of an understatement to say that a lot has changed. In fact, let me be more direct. Since I first joined Poly as CEO last September, in less than 9 months, not just a lot has changed, everything has changed. The way we work, all of us, has changed. The enterprise communications market in both needs and scale has changed. And in response, Poly has changed. More precisely, and what you'll hear about today from me and other business leaders is that Poly isn't simply reacting to a change. We are pursuing an intentional and aggressive strategic transformation, the most significant transformation in our 60-year history, to position ourselves to win in an expanding and fast evolving market. Let me be clear, our goal is growth. We believe Poly can deliver double-digit growth, and everything we're doing now is to get us there. That's a bold claim, but after spending some time with us today, I think you'll have to agree that there's a lot happening and a lot to come at Poly. First, let's talk about work. The future of work is here, and it's no longer a place. Look at us. We're operating in a world where at some point in the next 2 hours, we're going to find out by accident what investors own dogs and which of you have kids taking their classes at home. I said on our earnings call last week that we're well past wondering whether or not the impact of the coronavirus pandemic was temporary. Not that long ago, there was still some debate about whether or not the shift to hybrid working was temporary or permanent. We made the argument that the pandemic served as an accelerant for multiple trends already in place that pointed towards a highly distributed future of work. Businesses everywhere continue to move to the cloud. The infrastructure supporting data flow such as 5G technology continue their build out, and entire industry categories like healthcare with telemedicine are shifting their models to implement remote operations. And just last week, after a storm of criticism, the CEO of WeWork issued a public apology for appearing to slight professionals who choose to work remotely. I don't think we need to argue the point. Work is no longer a place. It's what you do and how you do it. The implications for collaboration and communication spending more broadly are enormous. COVID has drastically accelerated the digital transformation of work. There has been a step change in both the importance and mission of collaboration at every company everywhere. The more customers I talk to, the more I'm struck by the same fundamental need they all have. Our customers, regardless of what industry they're in or what function they serve, they all want total equality between those in the room and those who aren't. Stated very simply, this is our vision for Poly. This vision applies to telemedicine, rural health clinics remotely connecting to specialists, teachers working to keep middle school students as engaged over Zoom calls as in the classroom. I have one, trust me, that's a tough task. Board level brainstorming with directors spread around the world, and to agile scrum teams working between Silicon Valley and India. Some of our customers have referred to this challenge as the, quote, impedance mismatch, second-class citizen status, or just the downright inefficiency in the pre-COVID state of work communications. The future of work has to be better. Nobody wants to be late to a meeting because of an incompatibility between a communications platform and their device. Nobody wants to miss a sale because they missed a key question. Nobody wants to hold a job interview without being able to connect like a human, able to sense body language, engagement, and get nonverbal cues. Nobody wants to feel like a second-class citizen when they are working from home while others are in the office. More broadly, no business wants to fail to spot the next big problem, or worse, fail to come up with the next big idea because they cannot create an environment where all participants communicate on an equal footing, whether in the room or not. So what does all this mean for Poly? If work is no longer a place, then collaboration and communications more broadly is no longer about endpoints. It is about connecting people with technology and spaces seamlessly. Today, we do an amazing job of selling gear, some of the most innovative, reliable, high quality, and secure tools, not toys, for work. But once we sell that gear, it's installed in a conference room or it's carried in a backpack, and there's little tying it all together to truly transform the way people work, regardless of the space they work in. So we need to offer our customers a comprehensive approach to their business infrastructure, the combined hardware, software, and services to connect people, spaces, and technology to permit the future of work. Let's talk about Poly's transformation, where we are today and where we plan to be very, very soon. Our customers need more than just tools to outfit a specific location because they're trying to solve a fundamentally larger, more complex problem. Our customers are worried about compatibility. Even if they standardize their communications on Teams or Zoom, they have to be able to support meetings across multiple platforms for clients or partners that may have a different standard. And while we do our best to sell Poly gear into every room, in every office, and to every employee, the truth is that there are often other devices from our competitors in these offices, and they're not in a rush to throw them all out. We wish they were. It's already complicated for our customers to connect all of these disparate endpoints with multiple cloud collaboration platforms, and that problem is only going to get more complex as we all start to return to the office, whether that's daily, 3 times a week, or a few times a quarter, while we spend the rest of our time at home, working from a coffee shop, or even an RV. So our job is to solve all these problems. And that means Poly has to offer the best combination of gear, software, and services to unify the enterprise communications ecosystem. You know, the narrowest view of Poly today is to look just at the video, voice, and headsets markets. Look at the growth rates for our endpoints. Video and voice in particular are showing strong growth that is projected to last for years to come. as businesses everywhere adapt to the reality of the future of work. At Poly, we're selling into a group of markets that, in combination, are expected to show double-digit compounding growth out until 2024, according to research from both Frost & Sullivan and Synergy Research Group. Based on our product mix, our product lineup, and a far more aggressive go-to-market approach, we're confident we can, at minimum, grow with this market. This double-digit growth is propelled by a massive shift to video and by a tidal wave away from on-premises gear to the cloud. When I talk with customers, it's clear that almost every meeting going forward will involve video, and that almost every meeting will also involve at least one remote participant. With less than 10% of the 50 million conference rooms enabled for video today, there is a massive opportunity in front of us. Likewise, we are already seeing a sharp rise in demand for cloud-based voice systems from RingCentral, Zoom Phones, Teams, and others. During the pandemic, many businesses, small and large, have realized how drastically their legacy PBXs let them down. The 400 million old school phones out there are ripe for a transition to the cloud. Looking at calendar year 2021, we see even more robust growth in a set of categories that we have targeted with a suite of next generation product offerings. We have introduced innovative and in many cases award-winning new gear into the USB speakerphone market, the UC headset and personal video markets, and the USB video markets. We are confident our current products and our product roadmap puts Poly in the strongest possible position to capture this demand. Our core markets are healthy and growing, and that's a secular tailwind we're happy to have at our backs. But as I said earlier, modern communications is about far more than endpoints. Devices are foundational, but our customers don't just need hardware, they need help. There are a lot of chefs in the kitchen with multiple vendors, multiple cloud collaboration platforms, multiple work streams, and depending on the size of your business, thousands or hundreds of thousands of devices and users. To work, every call faces what we think of as a horizontal challenge. The table stakes of actually connecting professionals so they can work together, managing digital workflows, and meeting security and compliance requirements. Below that, there's a layer of management and analytics functionality, system monitoring, video and audio analytics, usage insights, and so on, that can create value for a client who wants to know what equipment is being used, how it is being used, and where it is being used. In addition, there are a set of AI and ML insights that Poly is developing that will create enormous value for our customers. Here, imagine video conferences being indexed and transcribed automatically with key highlights generated and distributed. Imagine having sentiment analysis following a sales call or key presentation. Imagine automatic and accurate to-do lists from video calls. There's also a layer of professional services and support that we provide. So if something actually breaks or goes wrong, there's a real person on the other end of a phone ready to help. All these communication functions and initiatives exist horizontally across the landscape of every call. Poly's future is that our solutions allow customers to connect and manage this entire communications infrastructure, regardless of what vendors they're using, what devices they're using, and where they're using them. So everything works together. Said simply, Poly connects it all. But we don't think it's enough just to manage this horizontal challenge. Every business faces a set of demands that are unique. Remote banking, rural telemedicine, and secure government communications all have a set of requirements that make them some of the most demanding customers in the world. We know because these are our customers. So we're organizing our go-to-market strategy so that we approach each of these industries with a deeper understanding of and solutions for their business needs. We like where our market is and where it's going, and we're ready to serve it. Everyone at Poly is pulling towards the same growth, the same goal, double-digit growth. We have a clear view of the future of our market, what our customers need, and how to serve them. We have the best gear and bring a growing set of valuable software and services solutions to customers whose number one priority is to improve and unify their communications infrastructure. First, we grow by owning hybrid meetings and the future of work. Poly will build, partner, or buy the components required to transform hybrid meetings to seamless work. We will offer a comprehensive solution that helps our clients manage digital workflows, before and after meetings, creates an improved, equal experience during the meetings, and provides insights to CIOs, heads of human resources, and CEOs on the use of essential IT resources and facilities. Second, we constantly move closer to our customers. We do that by delivering a set of solutions tailored to meet their complex and changing needs, whether it's healthcare's evolution towards remote health, financial services seeking enhanced remote interactions, or government services everywhere from legal to social services to education, undergoing their own transformation to remote service offerings. And third, our ongoing commitment to operational excellence will make it better to do business with Poly. Investments in our operations, growth, products, processes, and channels mean we'll be easier to work with and easy to buy from. Each of these three elements will drive growth for years to come. As we execute across these three areas, we will additionally create competitive protection, a moat, against competitors chasing our opportunities, allowing us to grow share. Chuck will speak to the details of our target business model in a moment. And following that, we'll turn the meeting over to leaders at Poly who are putting us in a position to win on every one of these fronts. You know, in the last few months, I have made a number of changes to the leadership team at Poly. Soon, I expect to announce a new chief operating officer to oversee the implementation of this broader strategic vision. The new COO position will help accelerate our transformation by unifying several key functions, such as business units, strategy, product marketing, and business development. We already have some world-class general managers for our business units that you will hear from today. So let me quickly introduce them. First, you'll hear from John Lamarck, whose business is foundational to everything we do at Poly, voice communications. John's an old hand at this, and no one knows more about voice than John. As he'll tell you, people keep telling him nobody buys phones, and he keeps selling them. In fact, over 30 million of them at this point. So there's a lot going on in this space, and John will give you a good overview of where we're innovating. Next, Bo Wilder, who leads our efforts in video. Our view is that video will be every bit as ubiquitous as voice for all human communications. Every customer we talk to tells us they expect every meeting will be a video meeting. The data infrastructure necessary to support this 5G, hyperscale cloud service providers exists and is growing. And it is certain the pandemic has accelerated the adoption of video. But while we all have become used to video calls, I think it's fair to say that not a lot of us are used to excellent video calls. There's a world of difference between peering into your shadowy laptop camera and yelling at your keyboard mic versus using the next generation gear Poly has. Cameras that follow the speaker as they move, monitors with built-in lighting, extraordinarily crisp images and clear sound, all powered by an operating system, Poly OS, built from the ground up to ensure the best video experience available. There's huge growth ahead in video for Poly, and Bo will tell you about it. As I said earlier, all of our gear, which we believe is the best in the market, is the tip of the iceberg. Christine Roberts leads the team at Poly, connecting people, technology, and spaces with software analytics, digital workflows, and workspace management, and by developing video and audio connections and insights using AI/ML. Christine has the technology that allows enterprise to function collectively, unifying communications across platforms, devices, and locations, rather than being a chaotic collection of individual choices. Christine's software and services team keeps CIOs everywhere sane with a single, clear picture of their entire infrastructure. Following Christine, you'll hear from Laura Marks, who takes us to market. In particular, Laura is responsible for forging and maintaining alliances with key partners in the communications ecosystem, Microsoft and Zoom, for example, so that we approach customers with what she calls appropriately the whole solution. She'll also speak to how we're working to get closer to our customers as we change our and their thinking about how to understand and extract the value of their communications. John, Bo, Christine, Laura, and their teams all have an integral role in Poly's growth story. Working together, they allow Poly to do one thing better than anyone else: connect it all. And finally, let me make a potentially obvious point. Poly is itself a business. So we have set ambitious targets for ourselves internally. And if we're going to be able to meet those goals, we have to be as relentless in pursuing operational excellence as we are in customer satisfaction. We are in the thick of an enterprise-wide transformation that is changing everything from our leadership, product roadmap, and go-to-market strategy, our financials and balance sheet, and our supply chain. On that last point, we've also invited our new Chief Supply Chain Officer, Grant Hoffman, to present today so you can hear directly from him. I think once you've listened to Grant, you'll understand why we see such an opportunity here for Poly. I'm hoping not to step on Grant's toes, but supply chain is such a front of mind issue. I want to lend some context. Well, the front page of every newspaper is trumpeting global supply chain issues. They're really talking about compromised semiconductor and electrical component supply. As it relates to the global shortage of semiconductors, what I will say is this: Apple has a semiconductor problem, Toyota has a semiconductor problem, and according to research I've seen from Goldman, so do companies in 169 industries, from breweries to ready-mix concrete. But let's just remember that 12 months ago, we were worried about the total evaporation of economic demand everywhere in the world. Today, we're worried about the evaporation of supply. My current view is that this is an issue that will be measured in months, not years. The next thing I want to point out is that the moment I joined Poly, I identified supply chain as our #1 target for operational improvement. What this means is that we have taken a complete inventory of our entire supply chain processes and exposures, cataloged and prioritized them, and are addressing them as we speak. So as it relates to Poly supply chain, we're excited because we have gone through and continue to go through the intensive exercise of upgrading it to be best in class. Before I turn to Chuck so he can give you a sense of how we're setting up for the next few years, let me also point out that in just a few months, Chuck and his team have done an incredible amount of work to fundamentally transform our balance sheet and financial flexibility. And they did so during a global pandemic, volatile markets, and unpredictable economic conditions. That work has given Poly the space, flexibility, and resources necessary to transform ourselves so that our business is ready to support the kind of growth that we're targeting. So let me now turn things over to Chuck, who will provide a more detailed view of our financial performance. Chuck.
Thanks, Dave. Welcome, everyone, and thank you for attending our virtual Investor Day. This is a great example of hybrid meetings and the future of work. The benefits are clear. We are all saving huge amounts of time and the expense of travel. However, I do wish we were in New York together. As Dave just said, it's an exciting time for us at Poly. We have a tremendous opportunity in front of us, and we are focusing our investments on areas we believe will drive growth. Let's take a moment and reflect on what we've accomplished at Poly over the course of the past year, because the read-through is clear and paints a picture of what's in front of us. We started fiscal 21 with our manufacturing facilities shut down because of the pandemic, just as we began to see spikes in demand in both our headset and new video products as people and companies alike scrambled to adjust to sudden and massive shift to remote work. We had a looming bond maturity. We largely exited our consumer business and brought in Dave as our new CEO. By the time the dust had settled in fiscal 21, we had grew video 50%, set a record for headset revenue in fiscal Q3, set a record for video revenue in fiscal Q4, launched multiple new product lines aimed specifically at the future of work, grew share in several key markets, aggressively managed expenses to protect our margins and improve profitability, hired key executives into leadership position, more than doubled our cash generation from the prior year, refinanced our 23 bonds with a lower coupon and extended the maturity to 29, retired $130 million of the term loan. If we set aside the consumer business, you can see that Poly grew overall revenue at 6%, while product revenue is up 9%. This is on top of a difficult Q1 to start the year. And here you can see our continued focus on managing our balance sheet, reducing debt, and improving our flexibility. Taken together, we believe these accomplishments are evidence that right now, as Dave said, the machinery of Poly's business has never been stronger. And that's a great position for us to be in because we see a significant opportunity ahead of us to drive long-term sustained growth. Before we talk about the long-term trends that we believe will drive our growth, I do want to take a moment and touch on near-term supply chain issues. Grant Hoffman, our head of supply chain, is going to speak to this issue in detail and provide a comprehensive overview of everything we're doing to make improvements on that front, which involves far more than managing near-term tightness and component markets. On our earnings call, we made it clear that we're going to face revenue and margin pressure in fiscal Q1 due to the global chip shortage. Clearly, this is frustrating for all of us because absent supply shortages, we estimate we would have posted sequentially higher revenue in the June quarter in excess of the $478 million we posted in the March quarter. However, because of the work Grant and his team are doing in the last 100 days to improve our supply chain across the board, and based on what we know today, we believe that our situation will improve in fiscal Q2. Unconstrained demand remains strong, not just in video and headsets, but for voice as well. And that demand, we believe, is durable and the foundation of our long-term growth thesis. When we were looking at our revenue, you could see that our headset and video demand was up significantly. The pandemic expanded our TAM permanently. I doubt there's a single person in this call today who, even if they expect to return to the office full time, doesn't want or need a second working setup for video calls ready to go. This is borne out by market research. We're looking at a video market that is growing rapidly with USB conferencing cameras up nearly 75%. Both the headset and video markets are expected to be larger and grow faster post-pandemic than pre-pandemic. And while the desktop phone market has declined, we are seeing a significant recovery in demand, perhaps not back to the historical levels, but a gap up from where we are today. There are roughly 400 million business phone lines attached to legacy PBX or proprietary SIP that will eventually transition to the cloud, creating additional demand for phones and headsets. Hybrid work has accelerated both these dynamics. As Dave said earlier, people keep telling us nobody buys phones, but we keep selling them. Microsoft, Google, Zoom are all driving voice solutions. Traditional SIP voice players like RingCentral keep growing and saving their customers money. But returning to the potential of the video market, here are some numbers to keep in mind. There are more than 50 million conference rooms out there and a multiple of that in professional offices. And the vast majority don't have any video connectivity. It's literally unimaginable that in the very near future, high-quality video communication solutions won't be a ubiquitous feature of any modern business. When we talk about video, though, it's this slide I like the most. Poly is gaining share in our key core markets. From Q4 of calendar year 19 to Q4 calendar year 20, we increased share in 3 of our 4 primary markets, and we have a number 1 or number 2 position in all core markets. It's worth mentioning we had the largest market share gains of any vendor in the USB video conference market as measured in revenue dollars, and also the largest share gain of any vendor in the single codec market when measured in units. We primarily compete in the single codec market with a disruptive price relative to the quality of our gear. So in this market, we primarily focus on unit share. Many investors ask about revenue contribution and gross margins for the various product families. This slide stack ranks each major product family from high to low, product margins on the right-hand side. And the pie chart on the left show the relative size of each product family. We then identify the current trends and opportunities to improve profitability in each. What you'll see is that the current trends are broadly supportive of demand in our higher margin products, and that has good implications for our margins going forward. I'd now like to take a few minutes and talk about our current gross margin trends. And here you can see the impact of a number of perfect storms, each of which we believe is creating a temporary margin dislocation. First, let me point out that Poly has done a good job of keeping both ASPs and product costs relatively stable over the past couple years. Second, the impact of increased freight expense is immediately clear. Freight costs have more than doubled during the pandemic. In the most recent quarter, freight accounted for 450 basis points of our cost of goods sold, up from a pre-pandemic average of 200 basis points. And again, while we think these pressures are temporary, we expect spot market pricing, incremental freight, and other items to impact gross margins by as much as an additional 300 basis points in fiscal Q1. We believe the normalized run rate margin of our business is in the low 50s. For example, in the fourth quarter, our margins were 48.4%. If freight expenses were normalized 2% rather than 4.5%, and other COGS were a more normalized 4% rather than 6%, gross margins would have been 52.9%. The path for Poly to return to those levels is pretty clear. First, normalized freight and logistics channels, which we expect to occur as the pandemic wanes. And second, easing tightness in our component supply will allow us to reduce spot purchases and increase factory loading. Turning to capital allocation and the balance sheet. We refinanced our 23 bonds in February, reducing the coupon and extending the maturity. We continued to retire debt, paying $100 million against the term loan in the last quarter. This reduces risk and is a clear benefit for shareholders. In addition, it also improves our P&L as interest expense run rate in 22 is expected to be over $12 million lower than it was in 21. All in, we expect to have improved EPS by 25 cents per share due to lower debt balance and lower interest rate on the new bond. Debt retirement is our primary use of free cash flow. Our leverage ratio is improving. Our current net leverage is in the low 4s. Our goal is to exit fiscal year 22 with net leverage at approximately 3.5 turns, and long term, we expect to achieve our target leverage of between 2 and 3 turns by the end of fiscal year 23. As all this relates to our long-term financial model, we're targeting 5 to 10% revenue growth in fiscal year 22 and double-digit annual growth in 23 and beyond. You've seen that there are hundreds of basis points of idiosyncratic cost pressures on margins, but we expect those pressures to subside. In addition, we've made significant operating improvements that have not only allowed us to defend our current margins in the current environment, but also allow gross margins to expand to the low 50s going forward. And while we're increasing sales and marketing OpEx to drive growth, we are keeping overall R&D flat, making sure to reallocate investments to areas of growth, and we plan to keep G&A spend flat to down from 21 with operational efficiencies. We also think we can keep G&A and R&D flat longer term, but gain scale efficiencies to improve profitability. What does all this mean for Poly and our investors? We have a strategy in place and are on track to realize a target business model that we think is both achievable and compelling. Simply put, the model is 50, 30, 20, 10, 3. 50. We believe we can improve our gross margins so they return to historical levels of over 50%. 30. OpEx as a percent of revenue should be approximately 30%. 20. EBITDA margins should improve to 20% or higher. 10. Long-term 10% revenue growth driven by growing markets and new products. 3. Achieve target leverage below 3 turns. As Dave said, we've seen a huge transformation of the markets we are in, and I believe short-term triage is being replaced with deliberate, strategic, enterprise-level approaches to communications. To us, that means an incredible long-term opportunity because serving the needs of the enterprise customers is what we do. Now I'll turn to Grant Hoffman, who manages our supply chain. Grant represents one of the many leaders at Poly who are focused on ensuring that our operations match our ambitions. But thanks to the chip shortage, he's discovered that he is, well, unintentionally, one of the most popular folks here. Thank you for your time, and let's hear from Grant.
I'm pleased to have the opportunity to speak with all of you today. I've been with Poly just over 100 days. However, I've spent the entirety of my career focusing on analyzing, remedying, optimizing, and operating global supply chain for some of the most complex and demanding industries in the world, including the automotive and mobile devices sectors. And while I personally believe supply chain is about the most interesting and important thing a professional can specialize in, I've learned over the last 3 decades that not everyone shares my enthusiasm. Said plainly, historically, not a lot of people get excited when they learn they're sitting next to the supply chain guy at a conference. Until now, suddenly I'm popular. It appears that as much as the coronavirus pandemic has transformed the way people in business operate, it has similarly transforms people's interest in supply chains. I'm going to spend time today talking to you about Poly supply chain, the challenges it presents, and the opportunities it provides. If you only come away with one idea here from my time today, I hope it would be this. Poly supply chain represents the single most underappreciated opportunity for our company to outperform in the years ahead. I appreciate that right now, when people hear supply chain challenges, the immediate thought is semiconductor shortage. And that's fair. Look, you know there's a problem when over at Apple, Tim Cook is publicly expressing concerns about his ability to source components. And Ford is parking unfinished vehicles in lots waiting for electronic parts. And Poly faces the same issue that Apple does, that Ford does, and that just about every company in the world that makes electronics does. No question, component markets are tight. It is unclear when that will ease, and a set of completely idiosyncratic events, including bad parking jobs in the Suez Canal and a 100-year ice storm in Texas, are compounding things. But as Dave said earlier, and I want to emphasize, this particular supply chain issue is extrinsic, 1. And 2, it's temporary. 12 months ago, we were wondering if economic demand would ever recover from the pandemic. Right now, we're wondering if there ever will be enough semiconductors again because there's so much demand. We know the answer to the first question turned out to be yes. And the odds are the second will also be yes. When? That is a difficult question. And daily I receive new information. What I can say is that calendar Q3 looks better than calendar Q2. And I believe the time it takes for the global markets to recover will be measured in months, not years. But that question, the issue of component supply, is absolutely critical, no question. However, I joined Poly because management understood there was a real opportunity to reevaluate the company's entire supply chain from end to end. More importantly, there was a clear desire, starting with Dave, to do whatever it took to ensure Poly has a world-class supply chain in place to support our ambitions as a company. And as Dave said earlier, those ambitions are big. We need a global, flexible supply chain capable of supporting a business that generates multiple $billion in sales around the world. I specialize in building and operating these types of scalable global supply chains. And I want to take the next 3 minutes to walk you through what that means for Poly, both in terms of execution and financial benefit. On the last point, given this is Investor Day, let me offer a sense of scale. If I accomplish what I've set out to do here at Poly, we will have the opportunity to deliver one of the largest cost savings in Poly history. Let's start with where we are today. The moment I started, I began and have now completed a comprehensive end-to-end review of our supply chain. Today, we're already implementing changes, but before I talk about those, I want you to consider the following. I see logistics opportunities. We have a complex distribution model centered around a series of global distribution centers that feed product into our distribution channels. As a result, many of our products travel over 10,000 miles before they land at a customer. I see opportunities to build stronger relationships with our key suppliers. We have our own factory, which is a huge competitive advantage, but we also have contract manufacturers who acquire components on our behalf, reducing our direct purchases from these suppliers and thus reducing our influence. I see opportunities in manufacturing. For the products we build in our factory, we can migrate to a less manual, more sophisticated assembly techniques. I see design for manufacturing opportunities. From my prior experience, I believe we have significant opportunity to incorporate cost savings during the earliest phases of product development by incorporating advanced design for manufacturing concepts into our development cycle and factory operations. I see opportunities to reduce costs by improving our lifecycle management process, including product transitions to ensure Poly's latest and greatest products are in the hands of our consumers. Lastly, I see opportunities for digital transformation and modernization within our operating systems and structure. Real-time customer order information and available to buy data is a differentiation Poly supply chain can bring to the market. While this may seem like a significant number of objectives, we've already completed a deep dive in a short period of time, precisely because we want to know with precision exactly what's going on and where we can direct our efforts. If there's one thing supply chain people don't like, it's surprises. The result of our reviews was to surface opportunities for improving the way we operate. Continuous improvement is built into the foundation of each supply chain I've been involved with. Dave knows it, management knows it, and the board knows it. And that's what's so exciting to me, because never in my career have half steps proven effective. And everyone at Poly is on board with the transformation of the global supply chain, taking one giant leap forward. The second thing we're saying, we have a solid foundation. Unlike a number of our competitors, we have a key asset, the flexibility of our own manufacturing facility. We can combine our internal manufacturing capabilities and experiences with outsourced contract manufacturing to globally scale as needed. And this flexible manufacturing model, properly operated, can help us create the global operational footprint that we believe will deliver a competitive advantage for Poly. But let's take a moment to talk about 4 objectives and tactics we're laser focused on right now in order to affect this transformation. First, network strategy. This includes consolidate our network so that we're very important to a select number of partners. For select customers, implement a direct ship strategy to trim thousands of miles and cycle time from shipments. Optimize our distribution center across multiple geographies to ensure landed cycle time and cost is industry best. Second, optimize our manufacturing, which includes partnering with engineering to improve design for manufacturing, which has a direct benefit on factory yields and cost. Automate processes where packaging and material delivery can be improved. Aggressively benchmark and measure cost. Every penny matters. Carefully manage country of origin given the volatility of tariffs and trade environments. Third, complete our digital transformation. Identify and organize our data. A simple statement that must be done correctly to build a digital foundation. Build and connect and automate our supply chain. Deliver an amazing customer experience so that customers know where their order is every step of the way. Fourth and finally, provide organizational accountability. Emphasize a culture of clear ownership and accountability by function. Planning, fulfillment, logistics, manufacturing, new product introduction, procurement, digital transformation, and supply chain strategy. Details matter, and at Poly Supply Chain, we are quickly understanding what it requires to deliver operational excellence. By accomplishing these 4 steps, not only will we deliver cost savings, likely in the tens of millions of dollars, but we will also improve our environmental, social, and governance process, or ESG. This is particularly focused on reducing our greenhouse gas emissions. Ultimately, executing these 4 steps leads us to operational excellence as defined by best-in-class on-time delivery, best-in-class time to market, a competitive cost structure, a world-class digital supply chain, and exceptional quality. My team and I are and have been working nonstop to identify opportunities for improving Poly's supply chain operations. And to be clear, we're also working around the clock as it relates to the near-term component supply issues. There's a daily war room meeting. We're working closely with our suppliers and communicating consistently with our partners to manage the message collaboratively. We are extending our relationship with suppliers with a process called Supplier S&OP, executing long-term strategic buys and refining our planning and sourcing strategy. There's no question it's an issue, but there's also no question it's temporary. And nothing is going to distract my team and me from making sure that the transformation of Poly's supply chain to operational excellence is permanent. I'm energized by all of this because of the potential impact on Poly as a business. As I said, we believe that opportunity can be measured in the tens of millions of dollars. I hope this helps you appreciate what we're doing at Poly. I do think all of us, myself included, are looking forward to the day when supply chain conversations are relegated to footnotes and the focus is back on demand generation. Thank you for your time and attention. I'll now pass it over to John.
Hi, I'm John Lamarck, and I'm responsible for the voice products at Poly. That includes desk phone, IP conferencing, professional headsets, and USB speakerphones. As I only have a few minutes to cover all of our great products in these segments, let me dive right in. As you know, we have been very focused over the last 2 years on strengthening our portfolio to ensure we are closely aligned with the areas of the market that best meet the needs of our customers and create strong revenue growth and profitability for Poly. Starting with open SIP phones, a category that we are currently ranked #1 in, we did see a decline in calendar year 2020 as a result of COVID-19. And while I've heard the rumors that the desk phones are no longer needed, let me actually say reports of death have been greatly exaggerated. Here are some interesting data points. Even with last year's decline, this is still a $1 billion market. The need for phones in specific verticals is not declining. Retail, healthcare, manufacturing, and government customers still use phones. Premise-based enterprise customers moving to cloud from either proprietary SIP, which is an additional $1 billion TAM, or proprietary TDM, which is another $110 million TAM, will significantly increase demand in calendar years 2021 through 2023 and beyond. And Poly is one of the few vendors that can truly help them on their journey. As a 30-year veteran in the voice industry, I've been lucky enough to build multi-billion-dollar and market-leading businesses prior to joining Poly. That in-depth knowledge led to a revitalization of our desk phone business over the past 18 to 24 months. Our VVX line is ideal for all SMB and enterprise customer deployments, commercial and government. With the release of our CCX line in 2019, this family of phones significantly expands our ability to support Microsoft Teams and the Skype to Teams transition for customers. In fact, we saw a revenue growth over 400% in this category during our last fiscal year. And with the addition of Poly Rove, a family of cordless handsets specifically designed to target high-growth vertical industries, our portfolio of phone products is extremely well positioned to take market share from other vendors in this space. From a safety perspective, we are also the only vendor currently embedding Microban, an industry-leading antimicrobial technology, into our phones, starting with our Rove portfolio early this year, providing customers with increased personal safety as they head back to the office. Turning to IP conferencing, a tough year as a result of COVID-19. Good news is that as a return to growth is expected as we see an increase in return to office activities. Our Trio C60 was launched right at the beginning of the pandemic and is already representing 50% of our conferencing revenue. This product wins in the market because of its high fidelity audio, its integration with our video portfolio, and its ability to application switch depending upon which video conferencing service is being used. Switching to headsets, Earlier this week, Plantronics celebrated our 60-year anniversary. Our audio excellence throughout that time has been remarkable. From transmitting voice from the moon to today's acoustic fence and noise block AI, we continue to lead the market in professional headset innovation. 2020 was definitely an incredibly positive growth time for headsets as workers move from the office to the home. Continued growth in this segment is expected as we help workers obtain more professional headsets for all-day comfort and wear. Last week, we announced our latest offer, the Voyager Focus 2, an incredible new take in our market-leading Voyager Focus. Our engineers were given and far surpassed the challenge of taking a product that was done extremely well in the market and made it better. And they did. They delivered digital hybrid active noise cancellation, improved comfort, and better acoustic fence technology. Our Blackwire headsets had record growth in fiscal 21, with revenue doubling year over year, and new product releases earlier in the year signaled continued innovation and attention to detail for our customers. We introduced a new Savvy DECT headset this year, the Savvy 7300, which improves security encryption to 256 bits and doubled the density of DECT headsets in shared spaces. This headset is perfect for those customers headed back to work concerned with security, like healthcare, financials, and government customers. I am super excited about this next segment, both from the market growth potential, which is at 22% over the next 5 years, and from our revenue potential with our new Sync family of speakerphones. After just 5 months in the market, we grew revenue 75% year over year and unit sales that set new records within Poly. Customer demand continues to grow as we receive numerous industry awards for this product, including the 2021 Red Dot Award for product design and technical excellence. In closing, I'm incredibly proud of the work we have accomplished over the past year, and I'm extremely excited about how strong our products perform against others in the market. I firmly believe we will keep the innovation momentum going and will continue to take market share in the high growth areas. Thank you, and now I'll turn things over to Bo Wilder.
Hello, everyone. My name is Bo Wilder, and I run the video business here at Poly. I'm excited to be here with you today to share an update on this very dynamic market. First, I'd like to begin with sharing how some of our past big bets in the space are really starting to pay dividends for us. Back in 2018, when we formed Poly, we predicted that the future of video would quickly move away from on-prem deployments, and the adoption of the cloud VAS providers would grow exponentially. Sitting here in 2021, that prediction may seem like a no-brainer. But remember, in 2018, Zoom wasn't even a public company, and Microsoft Teams was only 1 year old. Anticipating this rapid market transition to the cloud VAS providers, we placed a bet. And even though our roots go back 60 years making world-class hardware, this bet was all about software. We invested in creating a platform-neutral software operating system that we call PolyOS, which at its core enables customers the flexibility to run any of the lead cloud VAS provider applications natively on our endpoints, essentially future-proofing our customers' investments in our solutions. PolyOS also set the foundation for us to be able to invest in developing innovative new user experiences. Knowing our entire new portfolio that runs this operating system will share the benefit. This bet allowed us to push the industry forward in 2019, when we launched our first all-in-one video bars, the Studio X30 and X50, that run our Poly operating system. These solutions, they set a new standard in the single codec market by delivering professional-grade video and audio experiences for small and medium rooms at incredibly disruptive price points. PolyOS also powers the differentiated video production capabilities on these devices, like automatically detecting all participants in the room and group framing them, but then seamlessly zooming in on the active speaker in the room so that the remote participants they feel like they're sitting across the table. It's like having a professional cameraman produce your meeting. It delivers the optimal experience. PolyOS also enables our world-class audio innovations, like Noise Block AI and Acoustic Fence, which eliminate all the unwanted noise, like keyboard typing or rustling papers, that loud hallway traffic, from passing through to the far end. The remote participants, they only hear what matters, the voice of their colleagues. Today, the Studio X30 and X50 are certified with Microsoft, Zoom, RingCentral, GoTo, Starleaf, and we're adding more ecosystem partners all the time. In 2019, we also launched our G7500 codec, targeting the large rooms. And because it runs PolyOS, it benefits from the same video and audio innovations as the Studio X30 and X50. And yes, it can also run those VAS provider applications natively as well. To boil it down, our software operating system allows us to move at a speed necessary to win in this very dynamic market. And we are winning. In our recent fiscal Q4 results, we delivered a new record quarter for video revenue of $142 million. And when the March quarter competitive results get published, we fully expect to be the #1 single codec provider by units in the world. #1 position in a $1.1 billion TAM that's growing. It's a terrific milestone. But it's just the beginning of the video story of Poly. With the proliferation of VAS providers, many of our customers started utilizing more than one service inside their company. So we quickly recognized the need for a professional-grade audio and video experience with the plug-and-play simplicity of USB. So we launched our Studio USB solution in 2019, which enables anyone to walk into a room using any UC or VAS application on their PC and up-level their experience to professional grade. 4K video, room-filling stereo sound, and a high-performing noise-canceling mic array, all by simply plugging in a USB cable. But the applications of our video systems, they go well beyond the enterprise campus. When the pandemic hit and our schools were forced to figure out how to continue educating kids remotely, our Studio USB video bar, it became an essential tool to enable remote learning. Features like our presenter mode, it enables a teacher to walk to the chalkboard, sit in her chair, get up and engage her remote students, all with the confidence of always knowing our camera technology is framing her perfectly and effortlessly. The intelligence in our Studio USB, it allows teachers to teach and not have to worry about turning into an IT professional to get their jobs done. On the strength of this world-class Studio USB product, we have a strong #2 market share position in this $800 million USB conferencing TAM, a TAM that's forecasted to double in 3 years. And we continue to gain share in every quarter. Of course, the pandemic didn't just disrupt education. It disrupted everything and everyone. When we were all forced into our homes in early 2020, no one knew at the time if it would last days, weeks, or months. But very early on in the pandemic, we at Poly, we placed another bet that remote working would be here to stay. And even when it's safe to go back to work, that a third or more workers, they're going to choose a hybrid model of working, where they go into the office some days, but they work from home the other days. Our goal was to deliver the same mind-blowing video and audio quality that customers have come used to in their campus office, but deliver it into their homes. And in doing so, set a new standard for professional, yet personal, video and audio solutions to solve for this hybrid working future. In less than a year, from conception to launch, we produced an entirely new Studio Series family of products. And frankly, the early feedback has been amazing. Already, we have won numerous industry awards, including the prestigious Red Dot Award for Design and Technical Excellence and the highly coveted IF Design Award. I think the recent review in Forbes of our P15 personal video bar summarizes the industry response nicely. Enterprise plus consumer equals awesome. But what I'm most excited about is what our customers are telling us. Just a few weeks ago, one of our large financial services customers said that P15 introduced them to a product they didn't even know they needed until they used it. That is music to our ears. It shows we're pushing the industry forward. We're delighting our customers, and we're setting a new standard for what professional yet personal video and audio solutions look and sound like. The Studio P series, it opens up another $1 billion adjacent video market for Poly, and we believe it has significant growth ahead. These are just a few of the things we have been working on in the video collaboration team. With purpose-built solutions for every room size on the office campus, and now a personal portfolio for your home as well, we believe the breadth and depth of our video portfolio is second to none. We're focused on delivering future-proofed, professional-grade video and audio experiences powered by our software that will enable hybrid working to truly work. 2/3 of our video revenue now come from the new products in our portfolio, and we believe we are set up incredibly well to continue to take share in all the video markets we compete in. And frankly, we're just getting started. Now I'd like to introduce you to Christine Roberts.
I'm Christine Roberts, head of Poly's software and services team. I'm excited to be here and share more about the ideas that are driving our strategy, moving our business forward, and that are ultimately giving us a very clear view to the future of work. Dave mentioned earlier that business communications was really about the totality of hardware, software, and services that need to all work together to connect our enterprises and allow work to happen. This is something we hear directly from our customers every day. Let's take a step back and appreciate for just a moment what happened in the world of enterprise communication in just the past 14 months. First, we all got sent home unexpectedly, and we're told to stay there. The CEO, the sales team, everyone in HR, everyone in IT, support, legal, logistics, you name it. Then we had to figure out how we were actually going to keep our businesses running. And in something we generally took for granted, be able to collaborate with each other. This turned out to be far more exciting than any of us wanted. Let's think back to that first full week where every single one of your meetings went to video calls. Your first invitation was for Teams, but all you had on your laptop was Zoom. Fine, you downloaded Teams, but where the heck are your headphones? They're in your laptop bag for when you travel, but guess what? We're not going to be doing that for a while. You throw them in your ears because your kids are attending school in the room next door. But wait, no one can hear you, but you can certainly hear your kid's math teacher telling one of the kids to wake up. The folks on your conference call keep telling you to speak up. Turns out those headphones are great for music, but lousy for everything else. Your laptop camera makes you look like you haven't seen the light of day in a couple years. The guy from New York keeps getting disconnected, and the woman from Austin sounds like she's underwater. To top it off, your legal team is getting jumpy about your call's security because no one is on your on-prem solution. After those first couple days, you congratulated yourself for surviving. And you type out an email to your IT department telling them that they need to do something to uplevel the experience fast. You quickly realize you have a future of unlimited calls just like this ahead of you, and you're going to have to do more than just survive. You have to sell. You have to listen, and you have to understand. You have to be able to ask questions at the right time and be heard. You have to counsel, you have to manage, you have to work. And after thousands of emails with thousands of variables like different headsets, different laptops, different internet speeds, the head of IT knows there's a problem. Actually, everyone knows there's a problem. And it's not just a headset problem, it's way more than that. And that's when companies call Poly. We've just gone through a period where it's become clear to every business, everywhere in the world, that one, they can't take their communications ecosystem for granted. And two, modern business communications is an incredibly complex function because in order for it to work, it needs to combine the hardware, the software, and services together seamlessly and reliably in real time. All of this together is the business infrastructure that Dave has been talking about. And what excites me about where we're going at Poly is this. As you heard from John and Bo, we're making the very best gear in the market for professional enterprise-grade communications. My team's job is to live up to the promise of that gear so that for every one of our customers, as complex as these challenges are, They remain invisible to the teams that use them. But what does that mean specifically? Whether a user is on-prem or off, whether communications platform they're using is Zoom or Teams or RingCentral, and whatever devices they're using, wherever they are in the world, Poly's software and services unify these communications ecosystems. People call Poly if they want to have the very best equipment, but people are also going to call Poly if they want to have access to the best professional communications counsel, because they want best-in-class UC solutions. We provide planning and design services for things like conference room setups and space utilization. We help companies with deploying their solutions across the entire enterprise. We solve integration and migration issues. We optimize, we address security concerns, and we help companies integrate with their business applications. And people are going to call Poly if they want support, real support from a real human wearing a Poly badge and fluent in our offerings. But we have more, especially for those who have global teams needing always available support options. This is called Poly Plus, and it offers premium features enabling better visibility and troubleshooting for IT and end users alike, in addition to 24/7 phone support, advanced hardware replacement, and an industry-leading 3-year product replacement warranty. Finally, people are going to call Poly because business communications needs to be managed systematically and holistically in order to maximize the value of the business infrastructure. What devices do you have? How many? Are they up to date with the latest software? Who's using them? How often? Where are they? How strong is their connection? And how secure is their network? Companies using the expanding feature set of our software and analytics will be able to ask and answer all these questions and more. When I talk with your customers, one of the biggest challenges they're facing is the dramatic increase in managing and setting up devices for their employees, whether they're in office setups, at home, or evolving. Our customers can use Poly Lens, our cloud-based service that gives IT professionals the tools that they need to make sure that devices work perfectly, no matter where an employee is working from. Companies can track their equipment using our inventory management and interactive maps. With Poly Lens, IT admins can create device policies to enable a consistent experience across the enterprise and ensure their employees have the best collaboration experience. This software delivers complete visibility and granular control over every endpoint in a network, including customized settings. IT managers gain actionable insights on device health and usage and can manage their inventory from one powerful cloud-based solution. The Lens Insight feed is using machine learning to look across several data indicators and ranks thousands of insights by notability in order to bring the most interesting insights to the top of the feed. So IT teams don't have to go digging through the data to understand the health and adoption of their Poly devices. And we recognize that we're all human. So we've added wellness tips for our end users, like reminders to stay hydrated or stay active or get up out of our seat after we've done multiple video calls in a row. We've even baked in the ability to bring in natural sounds that allow people to stay focused and productive throughout their entire workday. Poly Lens enables a consistent and scalable insight reporting and management experience across all device platforms, from personal USB to rooms to desk phones and conference phones, making it easy for IT to manage their entire communications fleet in one portal across fleets that number in the millions of devices. And this is just the beginning. Before I wrap up, I should also point out one more thing that makes Poly unique. And that is, we understand that each of our customers are different when it comes to where they're at in their communications journey. The truth is, there aren't many businesses that aren't starting from a completely blank slate when it comes to communications. Choices and investments have been made, and they're often significant in terms of the capital and the time and the resources devoted to their integration. Poly is fully committed to interoperability and compatibility, something our competitors can't say. And that means our customers can come to us for solutions, whether they're in the cloud or not. And they can come to us with old equipment from other vendors. They can come to us with multiple platforms. They can be at the beginning, the middle, or the end of an enterprise-wide communications transformation. And in each case, Poly will not only be relevant, but will be a valuable partner. I'm really excited about our push to broaden and deepen our software and services offering. We're past the shock of the pandemic, which set off a scramble to put out a lot of fires. And the customers I talked to have now assimilated the hard lessons learned over the last year, and they're looking forward ahead very strategically. They understand how important a functional, reliable, and flexible business infrastructure is. Poly counts financial institutions, healthcare systems, and governments among its clients for precisely this reason. The gear has to work, and that's table stakes, but the communications ecosystem supporting it, keeping it operational and secure, whether we're in the office, at home, or ideally someday back on the road. That's what Poly does better than anyone. We're pushing forward on multiple new initiatives that will be introduced over the course of this year, all of which will ultimately help our customers do what they really want, take an extraordinarily complex business problem and deliver it simply. Thank you so much for your time. And I'll now turn it over to Laura Marks, who's going to tell us how we take that totality of the Poly offering, our hardware, software, and services, and go to market.
I'm going to spend some time today talking about the unique role that Poly is playing in the market right now and how we're approaching our customers, in particular with our alliances, and why we're seeing success with our efforts. I'll start by saying that I don't think there's another company in our space that understands or can address the complexity and sophistication of enterprise communications ecosystems end to end better than Poly. When Christine talks about Poly's commitment to interoperability and our ability to use sophisticated software applications to unify communications for users and IT, she's underscoring this point. Poly is not a vendor. Poly is a partner, and we're helping our customers address the most mission-critical needs of their businesses, the ability to connect and employees to work successfully. And this need is only getting more critical and more complex as hybrid work becomes the norm and new challenges around managing remote employees and office spaces arise. Since I've been at Poly, I've seen this evolution of customer needs and Poly's answer to these calls. I think the best way to capture what we're doing at Poly is to say that we can offer the whole solution. The whole solution may sound obvious in some ways, but I would argue that the power is in the nuance of what this really means for our customers. We've heard today about the great products that Poly has introduced. And yes, I'm biased, but I'm extremely proud of them. We're honored to have received a number of prestigious design and functionality awards over the past few months. What we have also discussed is the innovation happening around our software and services and how these evolve our products into even more powerful solutions for our customers. The award we received for Poly Lens and Poly Lens App demonstrates the recognition of Poly's innovation in this space. But there is a third leg to the stool that needs to be discussed. Products and services and software need to attach seamlessly, I might add, to our customers' underlying communications platforms. A lot of companies have a hand in the communications ecosystem. It means a lot of different standards on a lot of different platforms with multiple approaches to addressing hundreds of different use cases. It means complexity. Complexity that is unwelcomed and potentially problematic for the poor soul in IT who's managing a vast array of platforms, tools, and devices, or a working parent who is simply trying to connect to a meeting from home while their toddlers are screaming in the background. Complexity, which in today's smartphone addicted and cloud-based world should really just disappear. Here's where the power of Poly's alliances comes into the picture. Poly's alliances are the third piece of the puzzle that makes Poly the solution company that it is. Poly wins because everything we do seeks to reduce complexity for the customer. Our customers don't want to panic when they see an invite link to Zoom meeting at 8 a.m., a Ring Central meeting at 9 a.m., and a Microsoft Teams meeting at 10 a.m. They want to walk into a conference room or log on from a personal device and have everything work correctly the first time. They want devices that can accommodate different meeting types when people are at home or at the office, and they want to be an equal participant, whether they are online or in the room. They need those different devices to work across an entire collection of communications platforms, from 8x8 to GoToMeeting to BlueJeans by Verizon. They also want to know that if and when they choose to make a strategic institutional commitment to one platform, let's say native Microsoft Teams or native Zoom, all the other solutions they have in place, from phones to headsets to video conferencing devices, will deliver that desired native experience. Let's pause there. This means that the same devices that a customer has been using for multi-app communication can be converted into native Microsoft Teams and native Zoom devices. That is the investment protection and simplicity of solution that customers need, and Poly can deliver. We know how important this is. It is the core reason we've made a strategic choice to build an entire constellation of alliances with key technology partners that are absolutely critical to our customers' success. Here's a claim I'm proud to be able to make. Poly is the only player in the space that offers interoperability across platforms and amazing native Teams and native Zoom experiences across our portfolio. And by the way, the native experiences go across Teams and Zoom meetings and voice or calling, something that is becoming a requirement as more and more organizations move to cloud voice. But it's not enough just to offer the integration of our products into these platforms. And here's where that nuance of the whole solution comes into play. Our alliances are not casual. They are foundational to how we go to market and how we help our customers. Perhaps one of the best examples I can share is what we're doing with Microsoft, a true 360-degree partnership. First off, Poly has the largest portfolio of Teams certified devices in market and a robust array of Microsoft-focused service offerings. However, the way we are partnering around go-to-market goes above and beyond the products and the services that we have for Microsoft Teams. Together, Poly and Microsoft are truly customer-centric, and together we co-sell across various areas of Microsoft's business in all regions of the world. Poly's video interop service called RailConnect and Poly Global Services are enabling customers to seamlessly migrate to Teams. These motions are so effective and so appreciated by Microsoft that they prompted Microsoft to give Poly one of their top partner awards. In Microsoft's award blog, they recognize Poly's partnership success and how co-sell motions have positioned Poly to win customers from the competition, increase Teams adoption, improve customer experience, and drive usage of various Microsoft workloads. Our alliances are a key path to market for us and a win-win for our mutual customers. Dave made a point earlier. If we're going to succeed, we need to get as close to our customers as possible. Our customers want to be understood for their uniqueness. Understanding where customers are and helping them on their journeys to the cloud is key to building close, long-term relationships with customers. And along those lines, if we are truly going to solve communications problems and bring them the whole solution, then we have to solve not only the horizontal future of work, but the specific industry verticals as well. Hybrid work in healthcare does not look the same as hybrid work in education or banking. Poly is working hand in hand with customers and alliance partners like Microsoft and Zoom to meet distinct needs of different industries and use cases. We're creating suites of solutions that map to specific industries. While there are certain commonalities in communications needs, the demands of healthcare organizations differ from those we see in financial services or governments. We're organizing solutions and bringing on customer-facing industry experts to personally address customer needs in challenging categories. Our commitment to understanding customers extends to how we do business. Poly needs to be easy to do business with, as Dave said in his very first earnings call as CEO. We need to be able to sell to lawyers and not just law firms. We recognize the shift in buying needs for many organizations and are expanding our global e-tail channels to reach individual professionals. So the whole solution is here. Products plus services plus alliances with use case and industry focus via go-to-market channels that our customers need. All of which leads me to the final point I want to leave you with today. Dave has an ambitious plan around our strategy and growth. So when we go to market, we're not just trying to win the share of the customer's communication spend. After all, we're solving bigger issues and answering broader needs. We're trying to win a share of IT spend. As you heard from Christine and others, Poly is architecting entire collaboration systems and solving problems around security, meeting analysis, global device and management, and support, plus interoperability. Organizations are asking for the whole solution, and we have it. We've set ambitious goals for ourselves as a business, but when I think about what our customers really need, and I look at the whole solution we have to offer, products and services, coupled with the depth and breadth of our alliances, I could not be more excited about our future. Thank you very much. And now I'd like to pass it back to Dave.
Thanks, Laura. I'm so proud of this team, from Laura to Christine to Bo to John to Grant and Chuck too. I hope you agree that this is an exciting story. We're very focused on growth and look forward to talking about this more with you all. I'm now going to turn it over to Mike, and we have some time here where we can take some questions. So Mike, tell us how to do that.
Thanks, Dave. So we're now going to open the event for a Q&A of approximately 30 minutes. So to ask a question, you can press the raise your hand button on the lower part of your Zoom panel. At that point, I will introduce you by name, and we will promote you from an attendee to a panelist. At that time, you can turn on your video and unmute your mic, and you'll be able to ask your question. However, keep in mind that as you're being promoted, your Zoom client will drop in as attendee and your screen will go blank, and then you will be rejoined as a panelist. So keep that in mind. So our first question comes from Dino Diana. Dina, we're going to promote you to a panelist right now, and in just a second, you'll be able to ask your question.
Excellent, thank you. Thanks for doing this. So can you walk through maybe the 50 million conference rooms that are in the TAM today, and how long does it take to go from, let's say, 10% video penetration that you outlined to 50%?
It's going to take years. This is my perspective, right? I think it's clear to say that we're looking at a change of how people are evaluating conference rooms. And there's been a lot of proof of concept work going on right now. And as I mentioned during the earnings call, people are trying to figure out, okay, how big is the room that I'm going to build out? I certainly need to make sure I have video in all the huddle rooms, so that's obvious, but it's more kind of how am I going to build out the biggest conference rooms as well, given the new spacing requirements. So we're seeing proof of concepts now. I would say the rollout rate is varying by country as people kind of get a firmer sense for when they're going back into the office. And so this is a multi-year transition, certainly from 10 to 50%, which is great. This is not, there's not going to be a one-time pull through, I don't believe here. I think it's going to be people kind of looking at the evolving model. I mentioned this a little bit. We've gone through a detailed assessment of our own team and tried to figure out, okay, how much are we going to go back to a hybrid working style as well? And when we've gone position by position, office by office, we come up between 30 to 40% of our employees will be in the office roughly 3 days a week. And that's a massive change for us. So we're doing exactly the same thing with all of our facilities, trying to figure out where we can cut facilities costs back, of course, but also trying to figure, okay, we need to make sure everything has the newest Poly gear in it throughout.
Okay, and I believe you guys started out with Teams and Microsoft as the bigger partnership initially. And I'm just wondering if the past few quarters have changed maybe what your view of the market share will look like to those vendors like Zoom versus Teams versus Ring or any others that you want to highlight. How does that look maybe three years down the road between them?
I wish I knew that. I would know which stock to buy, but I think they're all doing phenomenally well. We have very, very tight relationships with Teams and with Zoom and with Ring Central, I would say. We're also seeing Google Meet come on a little bit, and we're seeing them a bit more in the marketplace, especially in education. So I'm excited to see how they can, as they kind of put more and more of a focus on the cloud business, how they can grow that. But right now, Teams and Zoom are our two biggest partners.
Thank you.
Thanks, Dino. So again, to ask a question, please raise your hand. I'm sure there are many questions out there. So so at this point, we're going to promote Anshul Shu, who's coming in just a moment.
He lowered his hand.
And you should be able to ask your question. Whoops, sorry, Anshu, you lowered your hand. So David Green is going to be promoted into the panelist venue. And David, you'll be able to ask your question in just a moment.
Hi, can you hear me?
Yes, we can.
Fantastic. A couple of quick questions. On the supply chain side, is this for specific products that you're seeing shortages? So just sort of any constraints by product area? And
David,
then
go ahead, I'm sorry. Let me address it at a high level, then I'm actually going to throw it to Grant, who is online with us live from his Chicago office here. So at a high level, we're seeing the most constraint on our newest products. Chuck indicated in some of his comments, right, we've had 700% growth year over year in our newest video products. And so that's certainly the area where we're seeing the biggest constraints, but we're also seeing it in some of the phone units that John Lamarck talked about. We talked a little bit about the uptick that we're seeing, especially from small and medium businesses on the phone side. So we're seeing it across a number of the different business units, but far and away, it's tied the most heavily to our newest video products coming out. Grant, do you want to comment on that a little bit?
Yeah, thanks, Dave. As you mentioned, we've had very strong growth in the video side, and it's a key focus area for us on chasing supply. And just to reiterate what I mentioned earlier in my remarks, we're directly engaging with senior leaders from these various suppliers. So they really see the vision of Poly, and they're supporting us. It's a great message that Poly has, and it's definitely resonating with our suppliers. And then just to maybe expand on your question, we're also with those vendors making sure that they have up to a 52-week view of Poly's requirements. So we're extending that view of Poly's demand to our key suppliers just to make sure they have a very solid long-term view of our business. So thank you. Back to you, Dave.
Yeah, Grant and I are having regular chats and dialogues with the CEO at all these major suppliers. And I wish we had been doing this a year ago. Maybe but I think Grant and his team are all over it now. And it's wonderful to be able to paint a long-term vision and really explain to these suppliers how big the demand is going to be over the next couple of years. And I think that gets them excited and make sure that we kind of get more supply.
And do you get to the position where you effectively have sort of 1-year contracts or long-term contracts in place with them, sort of guaranteeing you effectively supply based on what your demand requirements are?
Grant, you want to comment on that?
Yeah, sure. I would say it varies by supplier. But the good news with Poly, and as you heard from Bo, as you heard from John Lamarck, as you heard from Christine, our portfolio is very strong. So making those commitments to the vendors is not something that concerns us today. So again, case by case, we're dealing with each supplier separately. But the good news is we have very strong demand, and it's something that our partners, it's resonating with our suppliers as we provide those longer term views.
And then I think you've talked about the sort of improvement coming through in Q3 relative to Q2, sort of ongoing improvement. Just I guess maybe this is a question for Chuck, I'm not sure. in terms of when do you think the gross margin headwind from the supply chain constraints falls away? Is it by Q3 or?
Certainly. So just to clarify, because I think you're talking calendar quarters. Our year end is March 31. So we did sort of highlight 300 basis point reduction in the June quarter, and then we see long-term improvement back into the low 50s. We expect improvement in the September quarter. Grant has already commitments from suppliers, so we expect revenue growth from our June quarter to the September quarter. With that growth, I do expect, I can't guarantee it, but I do expect margin improvement, because as we have more capacity, there's lower factory charges, et cetera. I think it's going to be a while, 3-4 quarters, perhaps a little longer, until everything's working perfectly and the logistics and supply chain are optimized, the factory's loaded, and freight costs go back down. A big driver of freight, for example, is commercial air jets. And is the fewer number of jets that fly, the more the prices are up. And in some cases, they were up 10x early in the pandemic. They've come down. They're still probably 3x higher than they were. And so we see that as a tailwind eventually.
And I guess just a very final quick one. I think, Chuck, you mentioned the 50-30-20-10-3. I'm not sure if that's right. I was just wondering what kind of time frame are you thinking about when you mention those targets?
Well, it's certainly longer term, because this year we did say we're targeting 5 to 10% growth this year, and that's a longer term model. So I would expect that's sort of a a year or 2 years out would be the target, and if we can get there earlier, that'd be great. But the expectations ought to be longer term. This is what the business model looks like.
Great, thank you so much.
Thank you, David. So we're going to go now to Paul Coster at JP Morgan. Paul, we're in the process of promoting you up to a panelist, and in just a moment, you'll be able to turn on your video and ask your question.
There you
Thanks,
go.
Paul.
And I do apologize that I'm exhibiting a consumer grade headset here, but my desktop's just incredibly complex, and it's just gone awry, and it's nothing to do with your product, I hasten to add. Anyway, back in 2019, you rationalized some of your distribution channel a little bit, I think, to address some of the issues that Grant was alluding to, namely the sort of, the problem of a many-to-many relationship and, shipping product thousands of miles unnecessarily. And I'm just, we're obviously concerned that you don't repeat the same mistake, and I'm sure you won't. So I was wondering if Grant could elaborate on how you rationalize your supply chain a little bit, and maybe your distribution relationships without yielding share to competitors.
I think, Grant, let me jump in before, because let's separate the issues. 2 years ago, we had a sales distribution go-to-market challenge that we think is behind us now. What Grant was referring to simply is the mode of transportation of our products from manufacturing to distribution center. And in many cases, Grant can talk about the analysis he's done, but it's two separate issues. We're no longer making changes to distribution and go-to-market. Carl Wiese and his team have just killed it. They've done an amazing job. Grant is just optimizing logistics and supply chain. Grant, why don't you talk a little bit about your analysis?
Yeah, sure. Thanks for the question, Paul. I think, when I started taking a look at every single point, and what I mean is from factory to customer, and that includes going through a distribution center. And what I found is there's multiple opportunities for us to limit those numbers of, just think of them as miles, like how many miles does it take to go from a factory to a customer. And we've identified some very good opportunities with that. And obviously that reduces freight costs, which Chuck mentioned. It also actually improves our time to market. So when we get new products introduced, it allows them to be in the hands of our consumers quicker. So it's that network cycle time that I've identified some opportunities that we're going to improve this year.
I'm assuming that product was shipped directly from the manufacturing plant, or the primary the originating distribution center to some customers without going through the distributor. Isn't the distributor going to be disintermediated?
So there's, as you think about like the time to market, right? The
Mhm.
time that it takes to get product into a consumer's hands. We have, as you look at the competition, almost all of our competition offers some form of flexibility in that distribution mode, and that's something that we're looking at today.
But
Okay.
just to be clear, though, we're not disintermediating our distributors. These
Right.
are great partners of ours. We have no plans to cut them out. This is simply optimizing the logistics and flow of goods,
Okay.
make the path shorter to market, but not cutting out our distributors.
Right. Thank you, Chuck. That was key. I appreciate it. Thank you.
Thank you, Paul. So our next question will come from Eric Lipinski from Morgan Stanley. Eric, we're promoting you at the moment, and in just a second, you'll be able to ask your question. Okay, Eric, there you are. Eric, if you unmute, you can ask your question.
Can you hear me?
Perfect.
Yes.
Awesome. So I guess maybe just one quick one on some of the investments on the software side that you may need to make just around some of the software platform approach you were talking about. You know, how should we think about some of those products are available, but how far they are in what you plan to deliver versus what you have kind of as an offering today? You know, how much of an investment is there in R&D that needs to be made around that, and kind of what the timeline is to being able to offer that platform across the different video solutions?
Yeah. So Eric, you saw Christine, who now heads up our software and services sort of solution group, talk, and so she has an integrated team that's looking at a couple of things. She's looking at PolyLens, which is really the underpinnings or sort of the foundation for pulling together all the data off of all these devices and then providing insights to the CIOs and CHROs. And so that's going to maintain sort of very much a organic investment. It's an ongoing R&D investment that we already have in place. And I think you'll see us roll out more and more features with that. We then also publicly announced the Poly Plus sort of simplified services offering. And as part of that, the customers are getting a lot of access to some of the more advanced PolyLens features. And so we're in the fairly early days there, but it's a robust technology platform already that, you know, the world's largest retailer, for example, is happily deployed. And so we have a lot of expansion there. We continue to invest to bring in some of the older technology platforms that we've had to make sure that they're fully unified within that PolyLens framework. I would characterize that though very much as sort of the underpinnings for where the software needs to go. Some of the higher level items that I mentioned that kind of sit between Microsoft and Zoom and Lens are areas where we are evaluating whether we partner, whether we build, or whether we buy. And so there will be some further investment there. And I think obviously we'll come back to you all and be very, very crystal clear on that as we identify the components that we want to execute on there.
Got it. That makes a lot of sense. And then if I could sneak in kind of one more. You talked about gaining a lot of share on the codec video side by offering competitive pricing. I guess just wondering how you guys think about the potential, you know, gross margin versus share gains and growth in other product categories. Are there other categories where you could gain further outsized share by, you know, maybe offering slightly more competitive pricing, or do you know, obviously the 50% target being what you would see as the right level, but wondering if there's divergences in certain categories where you could gain more outsized share by just taking a couple points hit on margins.
Why don't I comment on that first, and then Chuck can feel free to add on as well, given the margin issues. At this point, the constraint is not demand, the constraint is supply. And so I truly believe, based on the products that you saw from the team, we would gain share if we had unlimited supply. So I think we're cost competitive already. And I think we're probably feature rich. And so I think we're very, very competitively placed, especially in the video products that you just mentioned. You know, if we had a slightly different perspective on the supply situation this quarter, then we'd be thinking about more aggressively looking at the share gains through discounting. That is not a situation where there's a need right now. There is so much demand that it's not a consideration at this point. If anything, I'm thinking about, okay, if I had unlimited supply, do I take a little bit more margin by reducing the discounts? But at this point, it's a supply constraint.
Yeah, I'll just comment. Single codec is such a great place for us to be. we launched these products with very disruptive pricing. You know, Cisco being the incumbent with much, much higher prices. We designed these specifically to generate really good margins that we think are going to be north of 50%. And it makes it way more approachable for our customers to go deploy those in the 50 million conference rooms and the multiple of that in private offices. And so that the price point is very, very approachable for, you know, every company from SMB all the way to the largest, you know, Fortune 100. And so the legacy video products were just so expensive that it was a barrier to getting into and proliferating across all those conference rooms. In addition, what's really exciting about what Grant is doing, he comes from a philosophy of design for manufacturing. We have just world-class industrial design. You look at our products, they're beautiful, but many times they cost a little more to manufacture. Grant has the philosophy of let's keep that same amazing industrial design, but let's build it for high volume manufacturing that improves both cost and quality. And so I think over time we could see margin expansion as effectively costs come down. And now that will take time for sure. But this is not an ASP issue. You know, we have, I think, a leadership position in these new video products, and I don't see single codec being, you know, any type of price issue. And I agree with what Dave said earlier about the rest of the fleet of products.
Got it. Thank you very much.
Thanks, Eric. Okay, we will take our next question from Anshul Sahu from Northland Capital. Just give us a moment as we promote you up, and we will get you into the queue, and you should be coming into the Q&A now. Yeah.
Hi, Mike, can you hear me?
Yes, we can.
Yeah, like I just wanted to know, like, how does your past quarter guidance and like assume sequential growth in headsets?
No. So, you know, taken as a whole, we believe headsets will continue to have long-term growth. We really do. But, you know, a lot of the growth in the near term is the recovery of voice. The demand for voice is really starting to pick back up. That will gap up and help to provide near-term growth. In video, you saw 700% year-over-year growth in new video products. That's where the lion's share of the growth will come in. I think, you know, we're very optimistic long-term in headsets, but most of the new growth in the short term is coming from those other two categories.
Right, and do you expect a new video product to be down sequentially in the June quarter?
We haven't guided to that level of specificity because quite frankly, it's day by day in terms of what manufacturing we're able to get. You know, clearly, even though, remember, Q1, our midpoint of guidance is 60 million higher than it was a year ago, but it's also about 60 million below what we think we would have done without the component shortages. So we're not commenting on that level of specificity for Q1, given how fluid the component supply issue is.
Right, and do you think the headset can grow in September and December quarter, like as you left the uptick from work from home?
We're not providing that level of specificity. I mean, certainly it's a very big TAM. There are, you know, tailwinds in headsets. There's two trends I'll point to. One is contact center. Contact center headsets are still way down below historical levels. We have not quite seen signs of that recovering yet. I do believe it will. I just am not sure if that's in September, December next year, but I do think that business will come back. And then there's also another key trend on moving from wired solutions to wireless. Now, on a unit for unit basis, that's really good for us because a wireless headset the price is quite a bit higher and the margin dollars are higher, but we're just not exactly sure how that transition is going to work. And so we have not provided that level of specificity out in September or December.
All right. Thank you.
Thank you.
Thanks, Anshul. So again, to ask a question, please raise your hand and we'll bring you into the panel. At this point, we still have a few minutes left, and I currently have no hands raised in the queue. So with no hands raised, I'm going to go ahead and turn the call back over to Dave and let him wrap up the event.
Thanks, Mike. I really appreciate it. Appreciate everyone's time and the attention, and hopefully soon, look forward to being able to speak with all of you here shortly in person. I want to make a few remarks to kind of reiterate some of the points that Chuck made just to close this out. If we can bring up that slide, please. So we're targeting a business model that I believe is very, very compelling. I kept asking Chuck to reorder these slides, but he said, Dave, it doesn't work. You know, you got to go 50, 30, 20, 10. I'm very focused on growth. I'm very focused on these 10% annual growth targets. I think there's a compelling market in front of us. I'm hoping we can blow that out. We need to execute as a team. We are very, very focused. I feel like we've made the leadership changes we need to make. I feel like we've made the product changes we need to make. We've made the channel changes we need to make. Grant is all over the supply chain changes that need to happen as well. So we will deliver on these numbers. It's going to take us a little while to get there, but I'm optimistic the demand is there, and we will execute across the board on the profitability and the growth that is required to make Poly a home run. So thank you all very much, and look forward to ringing the NYSE bell on the 24th on Monday afternoon to kind of celebrate the new Poly as we turn 60 years old. Thank you all. Take care.